Well, I got to talk about Friday. Friday was a big day. Jerome Powell, in 8 short minutes, whacked the tippity top 1% for $78 billion. They had a bad day. Mr. Jerome Powell walked up and kicked the stock market in the nuts, which is something I've been asking for months. What did you see? What did you hear? What was your reaction when you saw that 8-minute speech?
Yeah, I thought it was great. It was perfect. He came out, he was on point, reiterated what all of the other board members had said all, last couple of days leading up to that, or the couple of days leading up to it. And he sent the message that he is serious. They are serious about inflation, that they're not worried about a recession. Even if the country ends up in a recession, they're still going to do what it takes to get inflation down. Inflation, I can't remember the exact phrase, but, basically the people at the lower end of the spectrum are affected and hurting the most from it. So he's basically telling everybody, look, those of you with means, you're just going to take it on the chin until we get it down for those that don't have means.
Mm-hmm.
And, they said, hey, rates are going to stay high. We're not at neutral. We're going to continue to hike. I think the biggest takeaways were that rates are not going to be coming down anytime soon. They're not backing up. They're going to hike them and they're going to leave them there. And they're going to let whatever be done to get inflation down and under control. And they're not going to reverse because they know if they do, inflation is going to spike right back up.
Yeah, I thought there was a lot in that 8 minutes. The first thing that I thought was interesting is if you go back to the preceding two Fed meetings, right, where he does his 60 minutes of Q&A, it always felt like to me he was talking tough, but he always had a comma. It was like, hey, I'm going to do this and this, comma, but will be data dependent, or but we're near neutral, or whatever. He first and foremost got rid of all commas. It was like, period, in the statement, we are hiking rates. Rates are going up. Rates are not coming down. This nonsense of a Fed pivot in the short term ain't happening. Don't plan on it. So again, I think rates are going up. The other thing I thought was interesting was there's more and more talk for the first time, at least I'm seeing, about the Fed funds rate, Greg, going to 4%. 4%. What does that do to the 10-year? What does that do to mortgages? Could we see 7.5?
Yeah, and that's the other thing. So bond rates are up today, and yeah, if Fed fund rate goes to 4%, bonds are probably going to be at 5%. And if bonds are at 5%, then yes, you're going to see mortgage rates go up, and you'll get into the upper sixes, low sevens. The other thing too is, so people are tracking what he said, and he said raising and hiking, like I don't know how many times, and there's little charts and graphs that people did on it, but he said inflation 40 something times.
Wow.
And the interesting thing about what he's talking about is it's not just consumer prices, it's assets. He wants asset values to come down. They need people to feel less wealthy so that they can destroy demand across the economy. And one of those areas is housing. They're very concerned about housing because it's way out of control. And they understand, we're in the biggest bubble we've ever seen in all assets, and they got to do something about it so they can regain some semblance of credibility. And that's why he kept the talking points so far on script, because they've lost all credibility. Even now, a lot of people don't believe he's serious. A lot of people think he's still going to pivot. They think they're still going to reverse course. The other thing that they did not do is they did not address the balance sheet at all. Not once.
Yeah.
And for everybody watching, if you want to know what reduction of the balance sheet does to the markets, go look at 2015, 2016, go look at 2017, 2018. And it was the same time of year. And it was September, October, November, and the markets, sold off and started falling off a cliff. And treasury yields went through the roof, because when the Fed says unload the balance sheet, that means we're going to sell treasuries into the market. And they've been the biggest buyer of treasuries. They've been the 800-pound gorilla
for sure
in the treasury market.
And so mortgage-backed, let's be clear, mortgage-backed securities. Sorry, it was both of those. You're absolutely right.
Yeah, and mortgage-backed securities, we talked about it, I think, last week. A lot of people say, oh, the Fed's still buying, the Fed's still buying. They're not still buying. It takes a month or two for those to clear from the last purchase. The balance sheet roll-off is going to begin in September. So we're still a month away from the roll-off, but they have not been buying anything.
Yeah, they're the roll. Yeah, September 1st it doubles, right? They stuck their toe in it August 1st, very small, but it doubles. It starts going full tilt in September. So when I go
Yeah,
back
so
to
there's gonna be a lot of pressure on rates in the housing market here over the next couple of months. I think they're just gonna be uphill from here towards the end of the year.
Mhm.
You know, the housing market can tend to want to cool during that period anyways.
Yeah.
So yeah, it's gonna be interesting fall and winter for the housing market and for the stock market.
Yeah, so let's talk about rates, then we'll talk about housing, then we'll talk about stocks and crypto. So, kind of rounding up Jerome Powell, what I basically what he's saying, and I'm going to take him at his word. But the good news is we'll know September 21st is 3 weeks away, and that's the next Fed meeting. He has to deliver 75 basis points, or people are just going to say we don't believe you. It is one thing to talk tough, be succinct, clear, but if you don't follow through, the market won't trust you. The market obviously was caught off guard Friday. You don't have a 1,000-point down day if you expect him to do what he did. They didn't expect it, but he has to follow through. So we'll see
Yeah,
in
I think
September.
I'm not so sure it was so much a surprise as it was just algorithms kicking in.
Okay.
And yeah, I think and it was probably 50-50 from what I've been reading and listening to. Half of the market thought that he was going to come out and be hawkish. The other half thought he would be softer. So I think all it was we had a nice bear market rally
Mhm.
fueled by that neutral statement that he
Yeah,
made.
God,
It
yeah.
reached oversold. Rallies go higher than you think they will, but it was in line with
Mm.
previous big bear market rallies of 2008, 9.
Yeah.
Going back to the .com. I mean, it was in the range of those before it rolls over. So I think people just pushed that momentum as far as they could, and
Mhm.
now they're just unwinding because it's
Okay.
oversold, and they know that the Fed's serious and liquidity is going to get drawn, and now we're just it's an orderly unwinding. So
Yeah.
and who knows, maybe Powell's short, right? So
Yeah, maybe. Yeah, yeah, exactly.
he's got
And
some
th-
short positions on we don't know about.
and then the last thing talking about Powell was I think generally speaking, people now believe um, the most they can hope for is a pause, right? I think they're going to take rates up and on a pause, all right? Because there was the betting market pre Friday had a cut in Q1 that is
Yeah,
now out of the window. So I think you're right. I think the biggest game changing thing is not only rates are going higher faster, which he has said, he's basically taken the whole idea of a cut off the table, I think. So now let's talk
yeah,
about housing. As you know, housing is seasonal. We have just left the hot season. We are entering September, which starts to cool down. Um, there's a lot of people talking about a housing crash in price. Some of that has happened on a month-on-month basis, still up year on year. I actually have a very sneaky suspicion that rates will go up. As I've said, I think they're going to go to 7. But I actually think inventory is going to shock people and it's going to go down, not up, because more and more people are going to be like, I'm not going to sell, right? Part of a transaction, as you know, Greg, is a willing seller. And we're going to be entering the winter season, which generally is slower. Lots of people feel like they missed the top, so they're just going to say, I'm going to stay put. Also, they're not going to trade up because they're not going to go from a 3% mortgage to a 7% mortgage. I think we're going to actually end the year with lower inventory than we have today. And I think that's going to shock the market. What do you think?
I don't know. I mean, if it goes up to 7, you've got a lot of home builders delivering product that they have to finish. They have to bring it to the market, and
Mm-hmm.
they won't be able to sell it at the price they want. So it'll be interesting to see, what that number is in the pipeline. I mean, I think it's close to a million, that they need to finish up and bring to the market. So it depends on how that works. But as far as the resale market goes, yeah, people don't have to move now like they did before for jobs, this, that, and
Yeah.
the other. A lot of people, John Burns put out a thing. What is it? 60% of the
Yeah.
mortgages out there are less than
73.
4%.
73%.
73.
Yeah.
Yeah, 73% of the mortgages are 4% or less. So that's somebody who doesn't have to sell. They can rent it.
They
They
can
can do
rent it.
whatever.
They can just, and
So yeah,
again,
some of the
housing is not like you've got to live somewhere, right? And there are so many people I will agree with a lot of people out there. There are a lot of people that would like to sell. They want to reap equity. They want to get their money. But here's the deal. They're not going to sell and cash out because rent is crazy. As you know, it's going up, 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 especially for single family homes. And then they're not going to buy something else. They're going to go talk to their mortgage broker all excited. Oh, I'm going to cash out 150 grand in my home. I'm going to move to this nicer area. I'm going to get a 7.25% interest rate. Are you freaking kidding me? My mortgage payment's going to go up 270%. No, thank you. We'll
yeah,
stay put.
unless values come down, so then it's a wash, right? So if values can come down, if inventory can stack up, and every market's different, some markets are starting to see inventory stack up. Other markets like mine, there's nothing.
Nothing.
And
Yeah.
stuff is still selling quickly, and not multiple offers, not getting bid up. They're selling for less than what asking price is, and we're seeing price reductions. But the interesting thing, there's a couple of YouTubers out there talking about the housing crash is coming because of new builder inventories and debt to income ratios. There's one channel out there talking about these debt to income ratios, and it's just silly. People are not going to leave their house or let that house go if they've got a 2, 3, 4% mortgage. They're going to keep that. They're going to let the other stuff go. They'll default on a car. They'll turn it in. They'll default on credit cards. They'll work it out. So the whole debt to income ratio out of whack, whatever they're saying, it's like 40% or whatever. That's just silliness. That's because a lot of people have taken on huge car payments, which drives it up. I mean, the average car payment $750, and I think most people are paying over $1,000.
Yeah, I saw that, like $1,100. I'm like, what are these people doing?
They're buying new cars and just making the payment. It's just because you can finance them forever, and gosh, it's just it's crazy.
You're right.
And
it's not happening in housing. It's just not.
So that whole debt to income ratio thing is silly. Inventories are still down. So the housing crash people out there, they're way off the mark, and they're doing it just for views and things like that. And the data that they're showing, it just doesn't line up. And I'll tell you, one of the best people to watch is Logan Mohtashami.
Yeah, he's awesome. I've had him on the channel. He's awesome.
Yeah, he's on it. He's got the charts, and he's showing you it's just not possible for a housing crash at these inventory levels. It's just not possible. And you and I have talked about it. And you need rates to go at the 7% to kill demand in the housing market, because that will kill demand.
Yeah, it'll kill demand. And then over time, weeks, months, quarters, inventory will stack up. And eventually next year, again, for me, I'm still battling with Greg. People are calling for a price crash in November. I can't believe people are calling for a price. Real estate does not move that fast. We will likely
have people calling for a melt up in the markets by November, that we're going to go to the 50,000 on the Dow and these stupid numbers that S&P is going to double by the end of the year. I mean, people can call for whatever, but they're not backing it up with any real data that makes any sense. It just, you look at the environment we're in, but it's a very odd time for the housing market. I mean, it's a incredible time for the housing market, and you've got this dichotomy going on where builders are pulling back. You're going to have some inventory come on the market. They can cut those sales and sell them and just get rid of them, get off the books. But the thing is that they're not going to start any new homes. They're pulling back on starts. If rates get in the sevens, they won't start any new homes
until it's sold.
Costs are through the roof.
Yeah, exactly.
So all that needs to come into check. And, the other thing is so the housing market and the car market are two things that always lead big, massive, deep recessions. So even though the housing market itself is going to stay strong and healthy, the transaction volume is going to go way down. It already is. And that's all of the extra money reverberating through the economy that's going to contribute to more economic slowdown.
Exactly.
So even though you have a housing market that's still strong and not crashing or collapsing, the economy of the housing market is in serious recession.
Yeah, I totally agree with that. Actually, Logan is actually putting out there. Logan and I communicate on Twitter, and I've talked to him a bunch of times. The housing market is in a recession today. Transactions are already down 30%, which is commission and inspections and all of that. New home construction sales are down 20%. What I asked him yesterday is, Logan, it's cute that all these people are calling for a housing recession. I asked him, I should pull up my Twitter feed. I said, Logan, when can we say housing's in a depression? Because I think housing is going to fall like 1981, 50%. I think new home construction falls 50%. And I think existing home sales fall 50%. And all of this is going to shock people because you won't see huge national price declines. You'll have cities like Boise and Phoenix who got stupid, but nothing national. CoreLogic agrees with that. They're calling for a 4% year-on-year price increase. So again, I think things are going to be flat. I just don't see it. And again, I want to go back to my earlier comment. I'm going to call right now at the end of August. We will have less inventory in December than we have today because so many sellers won't sell. It's going to be wild to look at.
Well, in the holidays, people pull their house off the market anyways, so inventory levels always go down towards the end of the year. People are going back to school, the holidays, this, that, and the other. So yeah, inventory should ideally contract just by natural course of markets and how they work.
Yep.
Yeah, seasonality and things like that. But the real question is how do we get out of this? How does this change? And the only way it changes, so there were two things that happened in 2008 and 9, and this isn't anything like that, but the two things that killed the market, interest rates went up and you couldn't borrow money.
Yes.
So the credit
lending
markets,
changed.
it has to contract. You need credit controls, you need stiffer, more regimented lending requirements, because right now people can still get no doc, bank statement, interest only loans.
DCR,
you can still get a 4% interest only loan. Jumbo loans are cheaper than conforming.
Yeah, that's weird. Jumbo loans.
Yeah. So I mean, well, because it's supposedly a more qualified borrower, right? So arguably, if you're qualifying for a jumbo loan under today's guidelines, you're less likely to default because you got to put more down, it's a bigger house, you have more income than somebody who's in a conforming first time, whatever. So, it's really, really interesting to see if we're ever going to be able to fix this inventory issue. And it's on the rise, nationwide.
Well, that's a big thing.
Nowhere near where it needs to be.
Yeah, that's a big thing Logan's calling for. Logan's like, I don't know how we get out of this without inventory going up. But again, here's the deal, folks. Interest rates are going to go up. We're going to see days on market expand. It's going to be a slow process. If you're calling for a national housing crash, if you're calling for it any time before the summer of next year, you just don't understand the market. I'm willing to entertain that discussion June, July of next year. I don't believe it, but I can at least entertain it. If you're calling anything in November, December, January, you just don't understand how all this works. So let's close it up by talking about the stock market and crypto, because again, I think you're right. I think Jerome Powell was pissed off that the buy the dip, the bear market bounce, the rally. He's like, the 1%, the 10% of you that own the stock market, 90% of the stock market, I got to kick you in the nuts. This stuff has to come down. And I think he did that on Friday. What do you think about stocks and crypto as we get into the end of the year?
Yeah, so crypto is tied, as everybody has now realized. You and I were talking about this for a long time.
Months ago,
when I had my comments on my YouTube channel, I turned them off because all the spam and the scammers and all that stuff out there, and they're just out of control on YouTube. But when I used to get a lot of comments, a lot of people didn't believe me. They're like, crypto's not tied to risk assets.
It's counter the market. What?
Yeah, exactly. Yeah. So now they're all realizing, and all the crypto YouTubers now are starting to do stocks and things like that now, because they're finally realizing these are just risk assets tied to the markets. So that's the conversation. So it's risk assets. Right now it is risk off. So the markets, basically flew in the face of the Fed, said you have zero credibility. We don't believe you. We're going off to the races. We don't care what you say, because you're not going to do anything. You're not going to let the market fail. What the Fed came out and said, now, what they said is one thing. What they do is another.
Yeah,
they came out last week, and Powell said, we're serious. I don't care what the market does. Do your thing. We're staying the course. So that's what's going on right now. And as things work, a lot of this is going to hinge on the inflation print that we're going to get next week. Is it next week or 2 weeks, whenever that comes out?
So it'll be 2 weeks, I think, the Wednesday, the 13th.
Yeah, and then the Fed's response to that. So those are your next big headline issues.
Well, we also get we do get the job. I think this week we get Friday job number. I think that'll be a big deal, because last month, remember, jobs were expected like 250. They came in at 500, plus wages went up. I think Friday's a big number.
Yeah, and that's a double-edged sword. The stronger the jobs market, it's a great economy.
Good is bad, bad is good.
Wait a minute, the Fed can keep going.
Exactly.
So, you'll see some gyrations, but on the path that we're on, we're looking a lot like very close to 2008-9 in terms of the bear market activity. Very close to it when you compare those charts. This should be an orderly repricing and unwinding of risk assets, which is crypto, Bitcoin crypto. Stock markets are leading all that, and retesting of June lows. So what I expect
me too.
is probable is a retesting of June lows, and that's where a bottom could be put in. So if we retest June lows in the markets and crypto, holds, and it holds, then we could be carving out more of a macro bottom, as long as the Fed can plateau, inflation can plateau, and we can start looking at a mild recession and getting into more recovery as things kind of correct. So that is going to be the next major test of whether or not we're going to a deep multi-year bear market in risk assets, or whether we can start putting that bottom in, and we can kind of look for more longer term appreciation, and a revisiting of the highs. But again, if they start rolling off the balance sheet, we're going into a long-term multi-year bear market.
Yeah, this is going to be a lot of fun, and I'm so happy I get to talk to you every Monday. Greg, where can people find you?
gregdickerson.com. That's where all my information is and links to my social media. Go check it out.
Thank you, buddy.